Good afternoon. Thank you for joining us for our Navigating the Home Buying Process webinar with an emphasis on how to obtain a home loan. I'm Corby Gage. I'm the Executive Director of Coastal Housing Partnership. And with us today is also Kim Pascage, Program Manager for Coastal Housing Partnership. And today's webinar features two local loan officers, Kathy Gray with Guild Mortgage and Michelle Herrera with Cross Country Mortgage. So Michelle and Kathy are both part of Coastal Housing Partnership's network. And as part of this network, these lenders reduce their closing costs for their clients who are employed by companies that are part of Coastal Housing Partnership. And that is you. Most of our attendees today are part of Coastal Housing Partnership, and we have a number of closing cost discounts available to you, and the lender piece is one of that, a component of that. The format for today's webinar, I will be asking Kathy and Michelle questions about the process of obtaining a home loan and getting ready to purchase a home. The remainder of our time together will be for you to get your questions answered. We'll be recording today's webinar, so we can send you a link of the recording after the webinar today. So the webinar format means that your cameras are off and your microphones are off. So if you have questions, please put them in the Q&A, and you can ask your questions anonymously if you like. There's a option for that. And feel free to put your questions in the Q&A at any time during the panel. And we will get to those questions after our formal presentation. And we'll have Michelle and Kathy respond to those questions. And that's really important to us that you get your questions answered. This is about you and making sure that you know the information and have the tools and information and resources that you need to get started on your path to home ownership. Since the first step in the home buying process is meeting with a lender to find out how much of a home loan you can afford, the information you receive today is going to make you better prepared to take that important first step. So let's get started. Kathy, would you start by sharing a little bit about yourself?
Hi, my name is Kathy Gray. I work with Guild Mortgage in Oxnard. We're the office in Ventura County. We have offices throughout the state and throughout the United States. I've been with Guild almost 14 years, and I've been in this industry for a lot more than that. And I've been happily helping home buyers and homeowners throughout California. So I cover not just Ventura County, in other words. I am now a widow. I have 3 kids, and I enjoy doing what I do. That's my passion. And in the time that I can have off, I enjoy being with my kids and grandkids.
Thanks, Kathy. Delighted to have you with us. Michelle, would you tell us a little bit about yourself?
Yes, my name is Michelle Herrera, and I'm with Cross Country Mortgage. And like Kathy, I've been in the industry a very long time. My father was a real estate agent, and he's now retired. And I've been in the mortgage industry since 1988. So that's 35 years. And I've been, I would say, the last 8 years is really 100% loan advisor and helping clients purchase homes. And again, throughout California, and Cross Country is licensed in all 50 states. So we are able to help you in other states as well. I have 3 children, 3 grandchildren. My husband and I are empty nesters. So I take passion in dedicating my life to helping homeowners get into homes and answering a lot of questions that people have in this whole process. It just is, like Kathy, part of my passion in life of giving back.
Awesome. Well, attendees, as you can see, you are in good hands today. You're going to get a wealth of information from these 2 very seasoned loan officers. So again, thank you, Michelle and Kathy, for joining us. It's an honor to have you with us. Kathy, let's start with you. So when is the right time for a potential home buyer to meet with a lender? Do they need to be ready to buy right away, or is it a good idea to meet with a lender to develop a game plan? What's the timing on that?
Well, I would say before you meet with the realtor, because a realtor needs to know what you're pre-approved for. I mean, what range of homes are they going to show you? So the very first step is meeting with a lender. And a lender will go over your income, your credit, your debt, how mortgages work, what type of mortgages there is. Mortgages we have different programs. We work with the agencies, Fannie Mae, Freddie Mac, FHA, VA, and so on. And we got to adhere to each guideline. So, you really can't, compare yourself to your neighbor, or you got to start with the loan officer, get educated, and the education is tailored to you. So that is the first step, meeting with a lender. Now, sometimes you're not ready now. You could be ready in a month. You could be ready in a year. Either way, our job is to guide you through the process whenever you're ready. You may have income issues, you may have down payment issues, you may have credit issues, and that's our job to help you, work through those items so that you, at the end, you have the best program, the best interest rate, and so forth. So when you are ready to write an offer, you're ready to go.
So Kathy, do you find that sometimes people may think they're not ready to buy for a couple of years, and they meet with a loan officer and they find out there's a loan program available and maybe they're ready to buy in 6 to 9 months?
Yes, programs and guidelines change all the time. So if you're not ready now, we can plan for the future. And then if there are new programs that pop up, it's our job to share them with you.
Great. So when you're meeting with the lender, you're going in and asking for that pre-approval.
Yes.
Why is that pre-approval important, and what's involved in that pre-approval process?
Well, let me explain the difference. There is a pre-approval and there's also a pre-qual. A pre-qual is basically when you just tell a loan officer, or even on the internet, if you're shopping on the internet, which I don't always recommend. And you can say, yeah, I make 10 grand a month. And this is, I have a car payment of 400 and, what do I qualify for? That's a pre-qual because your income has not been reviewed. So a pre-approval takes you a step further, meaning a loan officer, a human, not a computer, a human has actually verified your income, your credit, your debt, and we can come up with the plan and we'll give you an estimate as to what you qualify for, or maybe 2 or 3 estimates, whatever you're thinking of buying, a house, a condo, a townhome, as realtors call them, but they're really plan unit developments is what we call them. Manufactured housing. So depending on what your plans are and what your goals are, we'll always keep that in mind. And yeah, it's just reviewing together so we know what your goals are.
So after that pre-approval, you're going to let someone know what their monthly payment would be and how much of a loan they would qualify for?
Yes, and definitely the pre-approval consists of, like I said, reviewing all that income. We run the automated approval through the system, whether it's Fannie Mae, Freddie Mac, FHA, VA, and that'll give us an automated decision. And with that decision, we can go ahead and feel comfortable to send out the pre-approval. Now, we can take it a step further and actually process your file and send it to the underwriter, and that would be an underwriting approval. And sometimes that's even better if we take it that far. But in order to submit to underwriting, we do need all that documentation up front.
And is there a charge for pre-approval? Is there a charge
No.
to meet with the lender and get that service?
No, if a lender tries to charge you a fee, run. Yeah, that's not a good plan.
So that's just industry standard not to be charged for that.
Correct.
Okay. Now, I know some people are concerned that getting that pre-approval process, that you're going to run credit score and that's going to have an impact on their credit. Is that, where is that these days?
Well, we do have to run credit. You know, some lenders, including us, run a soft pull. And I believe Michelle's company does that as well. So if you can work with a lender that actually runs a soft pull instead of the hard pull credit report, you don't have to worry about hurting your scores or getting all those telemarketers calling you because a hard pull was ran. Now we can start the pre-approval with a soft pull on the conventional loans, but I don't believe government loans will accept that, or we can't run the automated approval on government loans with a soft pull. So at some point we will need to run the hard pull, and hopefully there's not that much difference between the time we ran the soft pull to the time we ran the hard pull that will change that pre-approval amount, or what you qualify for.
Okay. So it sounds like this is a really important first step, is to get that
Yes.
pre-approval and get focused in on what your price range is and know exactly what to be looking at in the market. So Michelle, we're talking about credit scores and soft pulls and hard pulls and why, let me know a little bit more about the credit score. Why is that important as it relates to a mortgage loan?
So let me just go back one more time to when you do pull credit report. People
Sure.
are always intimidated about that hard pull credit score. So we all understand that, but when you're pulling for a mortgage credit score, it's not the same as an inquiry from a car loan or a credit card. It's not going to have the same impact. Usually, if you're shopping for a home, you have about a 30-day window where your credit score should not change for another mortgage credit pull. And then the credit reports last 120 days. So if you're going to be shopping during that period, it's usually a safe amount of time that your credit scores will not change. Now, when you do pull a soft pull and you go pull a hard pull 30 days later, like Kathy said, it could change. So I always feel like it's better to know what you're dealing with sooner than later. And then it is, credit scores are important because, especially for first-time home buyers, they want to know your credit worthiness, right? They want to know how you pay your credit. They want to see how responsible you are. They want to know if you're a high credit user or if you're minimal credit user. So if they're going to be lending you $500,000, $700,000, $800,000 on a new mortgage, they want to see your track record of how you're paying your bills. Do you have your credit cards maxed up? Do you have a lot of them? So it's very, they want to see what kind of a credit user you are. And at the same time, they want to make sure you do have credit. So there's people who come in and they close all their accounts. Well, that's not a good thing. So if anybody tells you to close accounts, don't do that until you speak to a loan officer and you really try to be strategic about your credit, because they want to have a history of how you paid your accounts. You have a couple of credit cards and you don't seem to need them or use them because they're still at a zero balance, right? Mm-hmm. So all this credit, the way you use your credit is very impactful on your credit scores. So people are very intimidated, or they just don't understand how it's looked at for a mortgage. But again, it's a reason why when you do speak to your loan officer, they will explain it to you. And then let's just say somebody comes in and their credit score is low. We can analyze it for them and kind of give them an idea of why it's low. Most mortgage lenders have software that's called like a what if scenario. So what if your $2,000 credit card that has a $1,800 balance, what if we pay it down to $900? What will that do to your credit score? And so we can be very strategic with the borrowers on how to improve their credit score, and we kind of advise them accordingly. And it's not like if you have a car loan and you have like less than 10 months to pay, they're like, should I just pay it off? No, because a car loan or any installment loan less than 10 months, it's not hit against your income to debt ratio. So there's a lot to go on your credit score and the way you use credit. So it's really important to talk to the experts and to try to navigate that so you're in the best position when you are ready to buy with your credit score. And people often say, like, you know, on Credit Karma or on this or that, that their score is so much higher. Well, the reason why is because there's different models used for different types of credit, whether it's a credit card or a car loan. They use different scoring systems, and a mortgage credit report is a different scoring system in its own. And so people are like, oh yeah, my credit's good. Credit Karma says it's 780. And then when we pull it, it could be 740. So there's a lot to be said about that. And if you want to get a more specific credit score on your own, the best one to use is myannualcreditreport.com. They'll give you a free credit score for you to check your credit score.
So it sounds like it's a really good idea to talk to a lender before trying to do anything to improve your score.
Yes.
Absolutely.
Okay. I do hear a number of people saying, well, I want to get my credit score, you know, really strong before I go meet with the lender, and I want to, you know, pay off this card or whatever. And often to me, it sounds like some of the things they're doing are going to send their credit score the other way, just because there's kind of the scoring model is a little complicated. So as a lender, is that something that you do? You're going to actually sit down with someone and help identify the ways they could improve their score?
100%. Yes. That's part of our job, is to advise them on their credit score. And at the same time, we don't want them paying a bunch of debt off if it's not going to really improve their credit score that much, because that money that they have that they were going to use could be used for the down payment. So we don't want to take that away from them. So it's very strategic on how we advise them on their credit. So, I mean, just a rule of thumb, it's always best to keep your credit limits 50%. Your credit balance is 50% below the limit. That's just a rule of thumb. So if you could just do that on your own, that would be great. And then the other question we get often is like, well, how do you, the mortgage credit reports pull all three bureaus. We'll take the middle score of the three bureaus. And if it's you and somebody else purchasing a home, we take the lower score of the two. So if my middle score is 780 and my husband's is 760, we're going to use 760.
Okay. Any way around that is that if you're buying with someone who doesn't have a stronger credit score, they're always going to take that lower one?
If you're going to use their income, if they're going to be on the promissory note, yes.
Okay. All right. Well, that's really good to know.
Sometimes there's co-borrowers where the wife doesn't work, or so it doesn't have any income to come to the table, and her credit score is low, and it's going to affect their interest rate some. So she might not be on the loan, but she'll be on title, or she or he, whoever it is. One of the, I'm not going to say either one. But
okay. Yeah. So another good reason to talk to a lender about that. So it sounds like the credit is one of the biggest indicators to a lender that they're going to get paid back, and sounds like it's a really important aspect of that loan approval.
Yeah. And a lot of times too, Corby, people will say, oh, my credit's perfectly fine. And then when we run it, there's like a collection account they had no idea that they had. It could be for like an old medical. And then we advise them on how to get that removed. We do what's called the rescore. And as soon as they find out that it was done in error, they get a letter. We can send it to all the credit agencies. They'll update the credit score, and their credit scores are back to where they should be. That's
another good reason to talk to a lender sooner rather than later. So sounds like to me, I always feel like it's a good idea to just to say, if someone's interested in buying a home, they should go see a lender, because they're thinking, well, I'm not going to go see a lender until I get a promotion, or I'm getting a raise, or I've saved up some more down payment. But there seems like there's so much more that you're going to find out from that lender. It's a good idea to do sooner rather than later. And one of those is getting your credit score as strong as possible.
Yeah, I feel like it's never too soon to be proactive. Even if you're going to buy a year, 2 years, 3 years, just know what you should be preparing for when the time has come. Okay,
great. And so sounds like there are ways to improve your score. So someone shouldn't say, oh, I have bad credit, there's no hope for me. That there definitely are things you can do to improve your score. Great. Good. Well, that's such a big topic, and I'm sure that folks have a lot of questions about that. That always something that people are always asking about. And I think you have some information that if people wanted more information about that, Michelle, you could
Yeah.
send out to them.
Yeah, I have a
And-
PDF format on the model scoring and how different creditors or different people model their FICO score. So if anybody wants a PDF of that, I'd be happy to email that to them. They could just send the email in the chat and I'll send it to them.
Great. And I think Kathy, you too said you had a number of handouts that might be helpful in terms of that pre-approval process. So again, there's so much information and education that's important that these two seasoned loan officers are really happy to share those resources with you. So Kathy, a lot of the folks that we work with are first-time home buyers.
Mhm.
Who is considered a first-time home buyer? Is that kind of a narrow definition, or are there some other
Yes.
aspects to that?
Yes, and a first-time home buyer is someone that has had no ownership interest in a property in the last 3 years. Now, you have to be careful if somebody put you on title, but if you didn't occupy that property and you'll have to prove it, then you could be a first-time home buyer. And as long as you don't live in the property that you're entitled, even though you're not on the loan, then you could be considered a first-time home buyer.
Okay, and so is that, you're saying 3 years? So if I owned a home, 10 years ago and I sold it 5 years
You're
later,
now a first-time home
I'm
buyer
still a
again.
first-time home buyer. Okay.
Yes.
All right, so that's good to know. So are there a number of first-time home buyer programs available, and
Oh, yeah.
are those income restricted, or how does someone go about knowing about those?
Well, again, in speaking to a lender, you'll find out all those programs if you do qualify for those programs, because each program has their own guidelines, their own rates, their own requirements. Some of them are income capped, some of them are you have to be a first-time home buyer. Some of them, if you're applying with your spouse, maybe your spouse may not be a first-time home buyer. So all these guidelines that we as loan officers have to make sure that each buyer fits in a box or doesn't fit in the box. Some of them, just to name a few, there's CalHFA, GSFA, Fannie and Freddie have a program designed for first-time home buyer. VA, of course, is always great for first-time home buyer. And also not to be confused with owner occupier, because FHA is a wonderful first-time home buyer. But if you're not going to occupy the property, then you can't use that program. There's city programs, and with the city programs, you just have to make sure that they have funds available, because they allocate so many funds, and then if they run out, then you can't use them. So consulting a loan officer that has access to all this information is key.
Okay, so and are these generally income restricted, or is it just if you're a
Yeah.
first-time home buyer,
Well,
they're available?
Some of them are income restricted. So, and some of them have a higher limit than others. CalHFA, for example, in Ventura County is over 200,000. So that, there's a lot of people that don't qualify for that amount. Then there's Fannie and Freddie that have their own program designed for first-time home buyers, but they go by area median income. So, and that's typically now, and it changes every year. So right now it's 80% of the area median income, and that would be 92,320 for Ventura County. And then there's some programs that will allow you to exceed that 80%. So it's important to speak to a lender that knows programs and guidelines and which program is better for each buyer.
Okay, so you can leave it to the lender. You don't have to do all this homework on your own and find out what you're looking for.
It's too much.
Okay, all right. Well, you guys keep track of that. So that's great. Okay, great. Thank you. Michelle, down payment, it's always a big, seems like it's a hurdle for folks because they're trying to save up for a down payment. And often we hear that, you need a 20% down payment. is that true? Do you pretty much always need a 20% down payment, or are there low down payment loan programs available?
Yeah, basically, you only need 20% down payment if you don't want to pay private mortgage insurance. And I always encourage buyers to get in whenever the numbers work, even if you have less than 20% down. So there's 3% down, 5% down, 10% down, and 15%, I mean, all the way up to 20. Now, keep in mind, the private mortgage insurance is additional insurance that you're going to have to pay for putting less money down. So the private mortgage insurance is going to be a little bit more if you put 5% down, and it'll be less if you put closer to 10 or 15. So each tier is going to be different, but it really isn't that much of a difference monthly. The private mortgage insurance is going to be based on where you're buying, your credit score, and your income to debt ratio. And to me, it's a better way to get into a home rather than waiting to save the 20%, because as you're waiting, prices of homes are going up. And then the way you can remove the private mortgage insurance on any kind of conventional loan, Fannie or Freddie, is, eventually you'll be paying down principal every month. And when you get to that 20% equity in the home, the private mortgage insurance will automatically fall off. You can also, if your homes appreciate in the next, 2 years or a year, whenever it is, you could refinance possibly and use a new value to remove the private insurance. After you've been in the home, let's say 2 years, and interest rates aren't favorable, but the market has gone up, you can work directly with the lender, the loan servicer, and ask them to do an appraisal and work with them to remove the private mortgage insurance. So it really is a good way to get into a home without putting the 20% down. And I think when I meet with my clients and I give them their monthly PMI, which is private mortgage insurance, they're pleasantly surprised. Oh, it's not as much as we thought. And, FHA also has mortgage insurance, but the regular conventional Fannie and Freddie, the 5% or the 3% down, the PMI is a little bit less. So,
Okay, so that's good news. You don't have to save that 20%. So it sounds like another good reason to go talk to a lender
Yeah.
and find out what do you really need for your down payment, and what does that mean to your monthly payment?
yeah, I bought my very first home with 5% down.
5%. Okay, well
Best thing I could have ever done.
that's
Yeah.
so much more achievable than 20. So
Yeah.
that's great news. That's great news. Now, what about down payments? Is that just something you have to have saved, or are there other sources for down payments?
Yeah, there's you can get family gift. It could be money saved. It could be, a lot of people don't realize that you can borrow against your 401k. So depending on who your 401k, who manages it, let's just say somebody has 100,000 in their 401k, I believe they could borrow up to 50% of it. So there's no tax consequences, and every month you just pay yourself back. So 401k is always a good option. You can check with your, financial advisor for first-time home buyers. There's some of them have, like you don't have to pay the penalty. For first-time home buyers, there's certain fees that are limited when you're using it to purchase a home. So that's another source. I always tell my borrowers to speak to their financial advisors and see whether or not they can use any of their retirement funds for down payment with less penalties. And that's a good option. And then, parent gift, you can also, if you have like a boat that you're selling, anything that has value that you can document or paper trail where the money came from, that can be used for down payment. So if you have a boat that you're not using anymore, it's worth $10,000 and you sell it to somebody, as long as you document the paper trail, the bill of sale, the cashier's check, the money going into your account, that can be used for your down payment as well. So any money that you put into your checking account when you're purchasing a home has to be traceable. And so whenever you get pre-approved for a home loan, we ask for your last 2 months bank statements. So if you're sitting with money somewhere, or you're going to be getting whatever it is, I would just say put it on deposit sooner than later.
Okay, that's just to make sure you don't have another loan outstanding, or that you're not borrowing your down payment.
Yeah, and it's also money laundering. It's big time
right.
money laundering. they want to make sure that this is, funds that are legitimate that you're putting into your account.
Okay, so that's why you're
Yeah.
asking for 2 months of bank statements to see that that's been in there for a period of time.
Correct.
Okay,
Yeah.
good to know. Great. Well, it's great to know you don't need a 20% down payment. So good. Kathy.
Wait, Real
Oh,
quick,
go
though,
ahead, Michelle. Yes.
For the 20% down payment, I
Mhm.
just want to go, it is for conforming loan amounts. Okay, so just for the Fannie Mae, Freddie Mac loans, it's not for a jumbo loan. A jumbo loan is a whole different category.
Okay,
Yeah.
great.
So I do have people come to me and they say they want to buy a home with 10% down and they want their loan amount to be $1 million. So that's not going to work.
That
So to
doesn't
me, it's
generally
just,
happen.
it's just different. Yeah. A whole
Okay.
different guidelines.
Another good reason to go talk to that loan officer and find out what those guidelines are. Where do you fit in that? So that's really helpful. So Kathy, so someone's now encouraged to take this step to talk to a loan officer and find out what they qualify for, what their credit is. How does someone select a lender? What do you look for in a lender? Should you be shopping by interest rates, or are there other factors to be looking at? How does someone know how to get started in that process?
Well, I mean, interest rates are important. However, you have to be careful how social media or what rates you read on the internet or newspaper or an advertisement, radio, whatever, because whatever rate is being thrown out there is not necessarily the rate that day. Or you need to find out if its points are calculated into the equation. So because interest rates do change every day, it's best to speak to a loan officer and learn how that comes to be. And if you're wanting to lower your rate, a buyer can do so by paying points. And by paying points, anybody can pay your points. It could be the seller, it could be you, or it could be a little help from the lender. Now, obviously, the lender's not going to help you with a huge amount, but sometimes, we can navigate and see what will work for you. As far as how to choose a lender, you do want to work with a loan officer, and hopefully local and in person or even by phone. But what I mean by that is beware of the internet lenders and internet advertisements. And yeah, there's good internet lenders, but because you can't really talk to them, and a lot of times they have a line where everybody calls in. So every time you call in, you get a different person. So it's best to speak to somebody that either it came as a referral to you by either someone a past experience or coastal housing loan officers, or sometimes the realtors refer you to a person that they have a history with. Whatever the case may be, if you're talking to them by phone or in person, you want to make sure you can communicate that you have that open connection. And are they willing to help you? Are they willing to answer your questions when you have them? Like for myself, I tell my clients, I'm kind of like a doctor. Call me as needed. And if you can't get a hold of your loan officer, then that's not really a dependable person. And it's okay if you miss a call here and there, but if it's a habit that you can't get a hold of them, especially on the weekends, a lot of loan officers may not work on the weekends. Well, you have to be accessible because that's when the buyers have more time on the weekends, if they themselves also work all week long, right? Or in the evenings. So work with the loan officer that you can build that reputation, that you can build that connection, and that you feel like they're taking your interest in mind as well.
It's really part of your team. I mean,
Yes.
this is someone who's really kind of holding your hand through the whole process and is going to help you get the best loan product for you. So it sounds like
Correct.
that's a really important selection. And like you say, recommendations, referrals, who has someone worked with before and why did they like that individual? But I think a lot of it is that chemistry too, is like, do you connect with this
Yes.
person? Do you feel comfortable talking to them?
Right.
And, making sure that any question you have is okay, that it's not, oh, you're asking too many questions or you should know that.
Right.
I think that's a really important piece of it as well.
Right. And then I just like to add one more thing. I did mention that interest rates change daily, but they are also tailored to the FICO score, the property type, the loan program, how much down payment you are applying. So it's not just, a one rate and it fits all. It's, it just depends. Everyone's going to be different, even on a daily basis. And when the rates are volatile, they could change 2 to 3 times a day. So unless you're comparing lender to lender on this, let's say within the same hour or sometimes within the same morning, you're going to get 3 different quotes. But again, be careful because the points also matters. Someone tells you the rate is 5% and someone else tells you the rate is 6%, you almost, guarantee that 5% will carry some points.
All right. And it sounds like if you're shopping by rates too, and you pick someone and you think has the lowest rate at the time, and you're not ready to buy for 6 months, they may not have the lowest rates at that
Exactly.
point. So that's kind of a deceiving thing. So let your lender find you a loan that is going to get you the best interest rates. So great. So Michelle, we're always hearing how the lending market has changed, and I know it's discouraging for some folks because we were in such a low interest rate market. We still are in a low interest rate market historically, but I know folks have, some people have kind of, taken a step back or thinking maybe this isn't the time to buy because interest rates have gone up some. Tell us a little bit about the lending market today, and are there strategies to mitigate these higher interest rates?
It's like a teeter-totter, right? So when interest rates were low, everybody was buying, right? But then you were also paying over asking price and multiple offers, and it was a lot of anxiety, a lot of stress. People felt defeated if their offer didn't get accepted. So now we have interest rates that are higher and less inventory, still a little bit of a bidding war, but not as bad. And people are seeing houses that they're on the market a little bit longer. So I tell my buyers and everybody that I speak to, it's like the time is always, now is always the time. Yesterday was the time to find out whether or not you should buy or not buy. It's like to know your numbers, know what you could qualify for, know what your budget is, and then just be ready for that right opportunity. Because to be proactive at any kind of market really prepares you the best for success. Because if a house is sat on one of my clients, there was a house sitting on the market and they were buying it during the holidays, and they went in and under asking, and they got the seller to pay for a 2-1 buy down, which is lowering their interest rate for the next 2 years. And the seller said yes. So they were extremely happy, and they got in with 5% down. So the markets, the realtor, the loan agent, and the buyers kind of all work together strategically when they're going in to present that offer, depending on how long the house has been on the market, depending on what the seller needs. Does the seller need a rent back? Does the seller need to move out right away? Does it need a quick close? And when you're completely underwritten, like Kathy says, with your loan file, you're telling that realtor and that seller that you're a serious business and you're ready to move, you're ready to take action, and you're determined to buy a house. So if you have a pre-qual or pre-approval, you need a 30-day escrow or 45-day escrow to close, you're not as aggressive in your offer or telling the right story to the seller in today's market. And I feel like these interest rates are, the experts are saying they're temporary. Once they do start coming down, people are going to be out there buying, asking over, you're going to be competing again, and it's going to be crazy. if you're buying in the market where interest rates are higher, and I've done this in the previous markets, my clients are all so happy that, before in 2018, interest rates were 5%. During 2022, they were all able to go down to 3% or lower. They were ecstatic because the goal is always to get the house that you can afford. And if you can lower the price, the payment later, it's a win-win. But if you can buy it when it's still affordable and you're not asking over, you're not paying too much for it with a higher interest rate, then you can, it'll never get any higher. Your payment will just get lower.
Right.
So it's math, and it's just knowing what you can afford.
Think of it.
And
this
then
way,
hopefully you
you're
can
in-
refinance down the road.
Yes, that's
Yeah,
what
and
I
if
was just
not,
gonna say.
yeah, you can. Hopefully you can, but if not, it's never going to get any higher.
Right.
Exactly.
Mhm.
So
Yeah, it's something you
there's
were
still no
comfortable with.
surprises.
Yeah.
Yeah,
And
you
you're
have
not
to
getting
qualify.
outbid by losing the home that you wanted. Right.
And the thing is that on paper, you have to qualify for these mortgages, even with the higher interest rates. So you should be proud of yourself that you can still qualify for this payment. Maybe it's not your comfort style that you want your payment to be a little bit lower, and that'll come in time when rates do come down. But I always ask my client, like, what is your magic number for your mortgage payment? What do you feel you can afford? And then we kind of work it backwards from that, right? This is the down payment you need. This is the price point you're going to have. And then I would say in today's market, there's a lot more people who have their magic number, but they actually qualify for more. And so we work to giving them the payment they're looking for. And if, for instance, they fall in love with a home that's a little bit pricier than they thought, they still qualify for it and they can go up.
Right.
That's great. Great information. Kim, it looks like we have some questions. Should we go to the questions from our attendees today?
Yeah, I see 3 questions right now. Please feel free to put your questions in our Q&A, and we're happy to answer those right now in this segment. So the first question is, how long is the pre-approvals and pre-qualifications good for?
Kathy, I'll let you take that one. As you're talking
Okay.
about the pre-approval.
So if we start out with a soft pull, typically that's good for 30 to actually 90 to 120 days if that program allows that soft pull. Now the hard pull credit report, again, it could be the same thing, 90 to 120 days for most programs. However, once you go into, if you're not going to buy right away, we may ask you for updated pay stubs and bank statements. We don't necessarily need to run credit again during that time frame that the credit is still good for. But once you start, once you have an offer accepted and escrows open, if that credit report is too old or we ran a soft, we're going to be needing to order a hard pull at that point. Okay, because then it becomes a live file. But always keep your pay stubs and bank statements ready to go. You don't have to send them to us every time, but if you're not ready now, once you tell us you're ready, we're going to ask you for updates. An underwriter may also run another credit report before we fund, and that's to make sure that you haven't incurred any new debt since the loan started. So yeah, it's very important to stay on top of those updates.
So you're saying you don't need to, if your pre-approval expires in 90 to 100 days, you don't need to update it or refresh it every 120 days, but just when you're ready to make an
When you're
offer.
ready, correct.
Okay. Okay, so it's still good information because you know what you're approved for, you know what your payments would be. And then, so I
Yeah.
guess unless interest rates change or your income changes, you don't really need to update that until it's time to make an offer.
No, and then you need that, then that's where that connection comes in. Because once you've gotten the preliminary education about getting pre-approved and when you're ready to buy, then we'll ask you, has anything changed? Maybe you had to buy a car, so now we have to calculate it in there. Maybe you paid off a car, so now we don't worry about that debt, and we can update your pre-approval amount accordingly. So it's very important to stay in touch with your loan officer, you know, when you're ready to buy.
Okay, great. Thanks.
And
Kathy.
Kathy, as you were answering someone, I maybe if you just have a little bit more of a clarification between soft pull and hard pull of a credit report.
Sure. So a soft pull credit report will pull all three bureaus, which is what we need. But a hard and the soft pull should not hurt your FICO scores if you're shopping around for, let's say, talking to another lender. I don't mean shopping around for other things, because FICO scores can drop or go up depending on the type of inquiries that are being pulled, like car loans, credit cards, that sort of thing. And in mortgage loans, like Michelle said, it has its own category. Yes. So the hard pulled, on the other hand, that goes right into your file. And so we don't want to, if we don't have to do a hard pull just yet, we'll protect your scores with that soft pull. But if you've done any activity between the soft and the hard, then that score, whether it's higher or lower, that's the one that's going to rule and be part of the guidelines.
Great, thank you.
But
Yeah, and I like
at
that.
the same time, it's when
Yes,
you
Michelle, go
are
ahead.
pre-approved. Yeah, when you are pre-approved, it's really good practice to kind of not be applying for any, like Kathy's, any credit unless you absolutely have to kind of keep that steady and not to be increasing your credit, your debt, monthly debt.
Okay, so
during the
that's
process.
credit cards as well as a car loan or anything. You just shouldn't be opening any new lines of credit.
No, wait to buy furniture
maximizing your
after you have those keys in your hand.
Okay, good clarification. Okay, Kim?
Great. Yeah, I like this. I like this next question. You're talking about shopping around for a lender, and they're asking, what does that process look like? What should be the deciding factors when selecting a lender aside from the approval?
Michelle, do you want to take that?
I think it should be, it's almost like how you shop for a realtor, right? So you want to find somebody who you can connect with, who's going to be answering your questions, somebody who you feel like is knowledgeable and accessible, and kind of suits your needs of what you're looking for in a loan advisor. So a lot of it will be, experience, accessibility, knowledge, and kind of a rapport, like somebody who really can speak to you the way you can understand them. People have different systems of how they are a loan advisor. Like some people will have teams and maybe you'll speak to their assistants and not to the loan advisor. So it's just a good idea to interview them and to see how you guys connect and just ask them any kind of questions that you want. And I think that the referrals, like Kathy said, is really important too. Or you can also, the Coastal Housing has a great list of loan advisors, and now with social media, they'll have Yelp reviews, they'll have Google reviews, they'll have Zillow reviews, so you can really do some research on behind the scenes.
Yeah, that's great information. Now, what if, should they be asking certain questions about the types of loans a lender has, or do all lenders have the same low down payment loans, for instance, or do they all offer FHA or VA? I mean, if you have a specific loan you're trying to get, is that a question you should be asking, or is that uniform across lenders?
That's usually uniform across lenders. I think that you should ask them, do they have, not all lenders have the fully underwritten part of it to be able, and the reason why it's important to go through the fully underwritten file is that, again, when you're making that offer, you don't have to, that loan contingency part is already done, and you can close your loan quickly, because sometimes people will need to close a loan in 15 days and not 30 days. So, and I don't know if all lenders are doing the full approvals. So that might be a question you want to ask.
And there are also some banks and credit unions that do not offer government loans. So until you speak to a lender, and the lender identifies best loan program for you, you really can't just shop for, oh, I'm looking for an FHA loan, or unless it's military, then obviously military will always want VA as their first choice. But military can also use FHA and conventional, but typically VA is the top choice.
Great.
Great.
Kayla, do you have a question?
Yeah, there's 3 more questions. The first one is, what is the family gift maximum amount?
Okay, Michelle, I think you were talking about the down payment, so I'll let you take that one.
So there's no maximum gift, no maximum amount. So a lot of people ask, so when a parent's giving you a gift, it could be for whatever amount they want to give you. The common question that we ask is the parents will have a question on, well, is this going to be taxed? We're not financial, we don't do anything with taxes. We just want to make sure that it doesn't need to be repaid. So from a lending perspective, we want to make sure there's no obligation that this is going to occur a debt. So we have the parents sign a gift letter saying that it's not to be repaid, and that's all we do. So on the other side, the parents might have other guidelines that they need to follow, but then there's some parents who just, they can give you 100,000, they can give you 50% of the down payment if they wanted to.
Is there a
So-
minimum that the buyer has to put in themselves?
No.
Okay, great, thank
Can
you.
I add something to that? Some loan programs do require that maybe a little bit, but typically not for first-time home buyers. And also
Jumbo loans.
on the parent side of it, I'm not licensed as a tax preparer. I'm not licensed as a financial advisor, but I will tell you that if the parents have concerned about the tax, the gift tax, they could go to the IRS website. The IRS does change it from time to time, so they'll allow a certain dollar amount. Like if they're giving it to their son, they can do that allowed amount to the son. Then they can always give the wife the same amount. You could break it up that way. We could do more than one gift letter. But yeah, if we really don't get involved with this, with the parents as much, we just want to be able to document that they are good funds. In other words, you didn't turn around, you didn't give your mom $10,000 and you deposited, or the mom deposited, and then now the mom is going to turn around and give it back to you. That's not going to work. So we need to make sure that the donor has seasoned funds. And typically we only ask for 1 month from the person, the donor. And it's up to the donor really to see what their limitations are if they're concerned about, taxes or penalties.
Great, thank you.
The next question is, what is the current jumbo loan cutoff?
Michelle.
It's by county. So
Okay. So I'll
Ventura
let you take
County-
it, Michelle, for Santa Barbara, and Kathy, I'll let you take that for Ventura.
So Santa Barbara, a loan amount above $805,000 is considered a jumbo loan.
And Kathy, for Ventura?
The last time I checked, it was 900 and something, but I just want to make sure. And also, if that's what you're asking for the limit on the loan amounts, because if you're asking for the limit you can purchase, that all lenders have different investors that we can also, some investors will go to $1 million, some will go to 2 million, some will go to 3 million. If that's what the question was, I'm not sure what context it was asked.
I was thinking that they were saying, what is the amount before it gets to a jumbo loan? So what's conventional, and then what is the jumbo? Does that sound like the right question?
So the high balance conforming loan limit is for Santa Barbara is 805. And the high balance limit for Ventura is 948,750.
Thank
So
you for
anything
checking
above
on
that would be considered, yeah, would be considered a jumbo loan.
But
Okay.
keep in mind that sometimes if you're in the jumbo market, if the pricing for the middle tier, the high balance tier is better, or vice versa, then loan officers will know how to navigate to which program, you're gonna use.
Thank you.
The last question I see is, since the lowest credit score is used out of 2 people, are there any pluses to that?
Kathy, do you want to take that?
Any classes to what? To improve your score?
Pluses to that, to
Uh,
if you're looking at the lowest credit score for out of 2 people.
as in advantages, maybe?
Yeah, advantages.
No, well, typically the lower score will rule, which means it's more of a disadvantage when it comes to rates, because the rate will be disclosed based on the lower FICO. So typically what loan officer will try to do is to help you improve that score. Or like Michelle said, if that person with the lower score is not bringing income to the table, then maybe we don't put them on the loan. We can suggest that, and it's up to them if they want to, still go on the loan, or if sometimes I have buyers that will bring me a cosigner, and they have lower score, or they have too much debt, and, we'll explain, well, do you want to get a different cosigner? So again, it's tailored to the individual. I hope I answered that question. If not, please.
Yeah, if not, write in there how we should clarify the response there. So if that didn't answer your question, let us know, please.
Yes, please. And also I have more education and information I can provide to anybody that asks after the class.
Kim, are there other questions? Kim, you're muted.
It sounds like that question was answered. Thank you, Kathy.
Okay, good.
Yeah. So I don't see any other questions. Feel free to add those right now. Otherwise, again, we are going to be sending out the recording to this. And
again, Michelle and Kathy have both generously offered to send out some additional educational information. So if you feel like you want a deeper dive in some of these areas, their contact information is here. And you can reach out to them, and they'll send you some more info. And if you want to put that information in the chat, we send that along to you. So we appreciate you joining us today. And Michelle, Kathy, thank you so much. Just provided so much great information for folks, and I'm sure they are ready to take that first step of meeting with a lender and making that dream of home ownership come true. So thank you so much.
Yes, thank you for having me.
Thank you for having us.